This is actually kind of crazy to me. Variable rate mortgage demand has dropped from 47% to 23% a month over month in the mortgage market. And now I don't know if this is a symptom of the sentiment in the market changing or the constant month by month attitude of Canadians who are paying attention to everything that Trump is doing, which seems to be a lot on a regular basis. Rates aren't dropping, inflation is just not chilling out, and Canadians are losing their patience. Whether you're renewing, you're buying, or you're still on the fence right now, the question everybody is pretty much asking is, do I continue to float or do I lock in my mortgage rate? But here's the truth. Waiting, it's not free. As you probably already know at this point, the cost of indecision, it's a real thing. And the reality is it's creeping up in the form of higher rent in some cities, lost purchasing power, and quite frankly, missed refinancing windows, which I'll explain in the conversation here today. And just when you think you've seen it all, Trump is threatening Canada over the digital service tax, GDP is turning negative, and inflation expectations are cooling. Now, all signs right now are pointing to rate cuts, but are they actually? Let's unpack what it all means today. Welcome back to the show. As you guys know, I'm Alex McFadden of Flow Mortgage Co., and this podcast is for smart Canadians who want clear, no bullshit insights about real estate and money. And there are three big things that we're going to unpack in today's episode. The first one is what we're going to call the decision dilemma. Why indecision is more expensive than most people actually realize, particularly right now in the middle of 2025 with this crazy up and down market. The market timing myth, which we're going to talk about, is why waiting for the perfect moment is a massive strategy. And for all those out there who are going to yell at me and say I'm pumping the FOMO tires, that's bullshit. That's not what we're doing today. We're just going to talk about facts because that's what we do here. And then the rate risk reality, which is that borrowers, you need to understand about how you need to understand how lenders and products and the risks associated with them have changed, not in the last 6 years, but in the last 6 months of the marketplace. But let's get started with the hard data. No bullshit. Let's get into the real stuff right off the bat. Starting off with variable rate mortgages and what's actually happening in this marketplace. I mentioned this already off the hopper. Variable rate mortgage demand has dropped from 40, it's actually 43%. I made a mistake there, to 27% in literally 2 months. That's crazy. Borrowers obviously are stepping away from any level of risk. And a lot of that probably has to do with the last month's marketplace suggesting that we were only likely to see another quarter point cut from the Bank of Canada, according to the markets. Now, on top of that, other data that has just come out recently includes Canada's GDP notice, which only came out in the last week, suggesting that GDP actually shrank minus 0.1% in April, and May is projected to show another minus 0.1% drop, which is two back-to-back contractions, which raise recession flags. Now, you might be laughing and saying recession is unlikely, and maybe that is true. Who knows? But this is what it's showing, and this is what the data is saying right now. We can't argue it. Down in the United States, south of the border, expectations just saw their biggest monthly drop since 2001. It's pretty wild. Down from 6.6% to 5.5, so 5%, sorry, with expectations going lower. It means there's lower pressure on the central banks right now. Now, on top of all of that, and this part actually blows my mind, mortgage origination. So this is the amount of people taking out mortgage loans, refinancing, applying for new loans, anything like that, just jumped by 32% year over year in April. So from 2024 to 2025. Now, that might not be saying much because April of 2024 wasn't a big year, but it does say a fair amount about the marketplace. We have seen more positivity in the real estate market, and we've certainly seen more people refinancing their mortgages. The highest spike in 10 years is what we just witnessed, that is notable to just give you some context. But a lot of that, as I mentioned before, is refinances and not just purchases. And no, it's not only people getting out of debt, but it certainly is some of that for sure. Among other people restructuring their loans and paying out the debt, we've got people re-extending their amortizations and switching lenders as well. Other notes of interest: real estate secured lending is up 4.63% with annual growth, rebounding from a low of 3.03%. And that is quite interesting, even though it's below the 10-year average. With fixed rates right now just under 4% for insured mortgages. So that's if you're putting less than 20% down. There are just a couple of options left remaining where you can get under the 4% mark. Now, this depends on your profile, your situation, the lender, what types of guidelines. Some are under 4, some are over 4. But the fact is there's some available under that amount, which is interesting because the bank margins are tight, meaning they haven't really increased the rates, even though the amount of profit they're earning has gone down. But here's the thing. Most of these rates that we're seeing under 4% are for straight renewals within existing banks where you're staying on with your current bank or renewing your mortgage. And that's really what we're seeing. Otherwise, the banks themselves are not quoting rates like that, not even close. The banks will quote rates around 4.4 to 4.8% day to day right now, unless you fight for it. Now, I think all of this information, a lot of data, is important because Canadian homeowners are moving, but they're not necessarily just buying. They're moving their loans. They're restructuring, as I mentioned previously, consolidating, or looking for different types of flexibility in the marketplace. Now, if you yourself are not actively reviewing your mortgage, you're probably honestly just paying more than necessary, whether you're coming up for renewal or if you're in a situation where you're refinancing right now. And I can anecdotally say I'm seeing this every single day, so I can speak confidently to the fact that most Canadians are just simply paying too much in interest, not just with their mortgage, that's part of it, but also with the other debt that they're carrying today, which is why I think we're seeing this more than ever. Overall, just to kind of wrap the lid on all these stats and this information, the market's moving. We're seeing more activity, and we're seeing a lot more changes as far as how people are playing the marketplace than we were before. Now, let's talk about what's happening in the rate market as it relates to the rates, inflation, and the market psychology. There are different pressure points and probabilities. We've got some downward forces in the marketplace right now that would potentially force the rate market down. One of those is the Canadian GDP going negative. That continues to happen. We will see BOC continue to act and look at the possibility of cutting rates, even though the percentages or the likelihood of them doing so is relatively low right now, which we'll talk about in a minute. It has increased as this data has come out. With U.S. inflation expectations easing, this also affects our bond yields, and it could keep them from rising above that 3%, which was basically destined before this week. And if that were to happen, we would see fixed interest rates rise, as we know. Canadian bond yields were just about there. Like, we're basically right on the cusp of hitting that 3% margin, which, as I mentioned in the past, means that if that were to happen, we would actually see fixed rates start to really climb. It just keeps getting stopped right there at that ceiling, which is a good sign for Canadians. It's boring, it's slow, but it just basically means rates are holding where they are right now. But the bond markets themselves are suggesting we are in tune for some type of an economic slowdown, although we'll wait and see what happens. Now, what's holding us back from rates actually coming down right now is even more interesting. Down in the United States, the PCE inflation, which is personal consumption expenditures, is still running hot. People are spending money. They're buying stuff left, right, and center like it's going out of style. So with retail spending still relatively high, that's having a direct impact on the marketplace. And it does mean that we will see and continue to see the cost of, that continue to hold up interest rates down there. What happens down in the US directly correlates what happens to us in Canada. On top of that, the equity markets are at all-time highs. Of course, the wealth effect may delay rate cuts. We have money. We're going to spend money. We're going to keep money where it is. And with Trump's trade posturing that just happened on June 27th, again, holding off any negotiations, going back to the tariff game again, this is going to slow down global growth. But unfortunately, it keeps the banks cautious, which means they're less likely to reduce interest rates in exchange for that caution in the marketplace. Now, as of today, the July 30th projections of BOC is expected to see a 42% chance of a rate cut of 0.25%, which means less than 50% chance that the BOC actually cuts rates by 0.25%. And you've got people out there yelling and screaming that we're going to see two more rate cuts. But on the flip side of that, there's no real data right now as of this very moment in time to suggest that that's going to happen. And most projections, at least the consensus, this isn't the Alex consensus, this is just the market consensus, that we only see a 0.25 point more rate drop. But as I mentioned, this year, this market has been topsy-turvy. Like, there's just no certainty behind it. And if this flip-flop keeps happening, we will probably continue to see us hold until there's some major data that comes out and suggests we should go one way or another. And this really matters to you because the central banks are waiting for real signals, right? They're waiting for inflation. They're waiting for job growth. They're waiting for wage growth. They're waiting for GDP. Don't expect any sudden cuts. I mean, I wouldn't expect any major changes or pivots. They've shown that they haven't done this yet. Why would they start doing this right now? if I were a borrower right now, I would be more prepared for a slow easing. And the truth is, if you're in the mortgage game right now, you should be looking at this from a perspective of flexibility, with certainty being the number one thing, and not just the rate that you're signing up for today. I can tell you those people that signed up 8 months ago that were just clamoring for the lowest rate are crying today when they cannot renegotiate or see those rates go down. And a lot of people are probably listening to this podcast and saying, but Alex, you told us 8 months ago when I did the podcast that we should be taking a variable rate mortgage. And the truth is, there were tons of reasons and signals that you should have. And by all means, I was right. You followed it down to the bottom. That doesn't necessarily mean it's the right or the wrong reason today. But I'm going to touch on that now, which is what could happen next. So let's talk through a few different scenarios. Number one, let's say rates hold flat through 2025. Very likely, very possible. We could just see flip-flops, quarter point up, quarter point down, quarter point up, quarter point down on the fixed rate side. Variable rates, we could see things stay the same or within a quarter point. Obviously, if that happens, there could be a big opportunity. I would look for, 3-year fixed rates to continue to be really opportune, and anything shorter probably just doesn't make a lot of sense right now. You're paying more for it. There's no value in doing so. And you can actually opt for, within that 3-year market, within a 0.25%, you can choose some very flexible different term options, which allow you to take advantage of rate drops if they happen. A risk associated with that is that if rates fall faster than they're expected, and you could have gone with a floating rate because BOC decides to cut, then obviously you don't benefit from that. And that's why if you do decide to go that 3-year fixed rate route, I highly recommend going with a monoline lender if you can, that has a much less damaging prepayment penalty. For context, you take out a $500,000 loan, and let's say you're with big bank A, B, C, or D, and rates drop by 1% on the fixed rate side. Well, as of today, those people that did that last year, they missed their window. Now they're seeing penalties on a $500,000 loan of $18,000 to $25,000. Whereas if they went with as of today, at least, a standard or a monoline lender, even if the rate was a quarter point higher at the time, those prepayment penalties are closer to $4,000, which means they can refinance and it still makes sense to do so. That's the big caveat when it comes to picking that rates and those decisions. Now, in the second scenario, this is how it could play out. We could see a mild recession, and that could mean that we see cuts in Q1, Q2 of 2026, or even Q4 of 2025, which means that a variable probably would have been the right play. Take the variable, watch the market, look at if it makes sense to refinance in 2026, or ride the market realistically. Again, the caveat to this is then again, you have to look out for those penalties. Don't just take the low frills product, the cheap rate, because it's going to cost you more money than it would have otherwise. You also got to make sure your credit is still strong. Banks are definitely looking at your credit and your asset profile right now when it relates to different terms that are available. And you can also look at the possibility of locking in. But again, remember, those typical lock-in terms are never going to be as good as if you were to go to a new lender and bring them your money. Scenario number 3 is where we could see inflation accelerate. We could see energy costs go up. We could see wages go up. We could see spending continue the way it is right now. And if that were to happen, then you're probably best to secure a longer fixed term rate. Again, be very mindful of that prepayment penalty consideration. I think a lot of people are not paying attention to that and being aware. Like 5 years is a long time. Think back in your life to what happened 5 years ago and where you were. Probably a very different state. And it's pretty tough to plan out exactly where you're at financially and real estate wise. So my feedback there again comes back to flexibility, but that long-term fix could end up saving you the most amount of money, as long as you're conscious of those breakage fees. With lenders having those crazy interest rate differential penalties, again, get caught with your pants down there, it's going to cost you 20, 30, 40,000 bucks, which means it was all null and void in the end. Now, my insights on the matter is like, number one, focus less on predicting what's going to happen. And because the truth is, if you're wrong, then all this is irrelevant, right? My feedback is focus on can you exit? Is there a refinance option? Can I blend my mortgage with a term? What does it look like if I were to port it? And truthfully, that's the conversation that people aren't having right now around their loan, and they need to be having. So what are Canadians doing right now in these scenarios? Let's walk through these different assumptions and talk specifically what Canadians are doing with facts. So what if rates were to drop 1% in the next 12 months? At a $650,000 loan at a rate of, let's just say, 5.29 versus 4.29, so last year to this year, that equals approximately a $360 monthly difference depending on the compounding period. Over 2 years, that's $8,640 of savings. Specifically, if you can refinance, you need a low penalty, you need good credit, and you need to have at least 20% equity in the property to be able to take advantage of something like that. Now, the opposite curve, if rates were to go up 0.5%, the same payment on the mortgage can bump up by $160 a month. The stress test helps you here, and that's one of the reasons the stress test has been pretty positive. Remember, you have to qualify for rate 2% above where you're at, but obviously your cash flow is negatively impacted, meaning you spend more money monthly on this as opposed to the things you want to, whether it be groceries or life or investing or whatnot. Now, if in a third scenario, real estate prices were to climb, I know people are saying, well, there's no chance that real estate prices climb by 10%. Well, who knows? I don't know. I don't think anybody predicted 2020 to 2021 and 2022 for that matter. But the reality is let's just hypothesize that property values were increased by 8 to 10%. An $800,000 property is now $880,000. A 20% down now increases a property from $160,000 to $176,000. So if you're the person that's like waiting for the perfect timing in this marketplace, although I don't project for an 8 to 10% increase in values, with the amount of buyers sitting on the sideline right now, I think the reality is you have to be hyper conscious of this like wait and see approach, because it'll eventually catch up. Like it always does, no matter what anyone says. And if somebody is now thinking, hey, is now the time to buy or not buy, just my feedback there is don't buy based on predicating it on where the market is at. Buy based on your need for real estate as a home and affordability in your current marketplace, because truth is, property values go down 5%, it is what it is. It'll probably go back up. If property values go up by 5-10%, well, that could be the difference between getting into the marketplace. Not only on $800,000 to $880,000, there's a $16,000 down payment difference, plus there's the difference in interest, which could be literally thousands and thousands of dollars over the course of a year. And the cost on your payments, obviously, for an extra, $20,000-$30,000, or in this case, $80,000, an extra $450 per month. So it's pretty significant. I think the truth is, like, Canadians are not paying attention to the flexibility that they have to be able to purchase and buy in this marketplace compared to a few years ago. There's no doubt that we're seeing all this negativity around affordability, which is a real thing. Like, it is a real thing. But as we know in the last podcast / video that I produced, when we look at the CMHC report, even they're screaming, yelling that not only do we have not enough building, we have the wrong type of building, which means that Canadians are eventually going to get even more squeezed anyways. So whether or not you think it's affordable to buy, if you want to be a nation or a renter for life and see rental rates continue to increase and not really own your home, then continue on where you are, because I think that this kind of comes back to the decision dilemma. Do I get into the marketplace now, knowing that the market is kind of like, teetering along based on the assumption that this is going to give me the affordability I need today so that 3 to 5 years from now I'm in a better place? Or do I continue to wait and see what happens? Now, so let's just wrap up the three themes here. I mean, the thing is, your reality, your options on the mortgage side of things, the dilemma that you're going to face is doing nothing is truthfully still a decision. And for all those people renewing in the next 6, 12, 18 months, doing nothing at all could cost you more money than actually making a decision on something today. From a timing perspective, as far as the real estate values, do I buy now? Do I invest now? Do I wait now? Nobody knows the bottom. Like, the truth is, nobody is here to tell you when the bottom is. I'm not telling you it's the bottom. I have no idea. But the truth is, the best time to buy a piece of real estate is when you're prepared to do so. From an affordability perspective, that's on you to determine, or you can reach out to someone like us to figure out where it's at. But as it relates to that final point that I've made, and you've probably heard this theme throughout the entire conversation, in a state of flux, in a market of flux with so much uncertainty, it's really about flexibility, which includes the penalty structure. There is no magic pill around this stuff. You have to make a decision. So the decision you make really needs to be predicated on the amount of flexibility, even if there is a minor cost associated with that up front, because that can literally save you thousands of dollars over the course of a long term. Now, you want to use that with a plan and be clear and have some way to actually follow that, which is something I do with my company, with my clients. But the truth is, if you're not looking at it from that perspective, you're probably looking at it from the wrong perspective whatsoever. Now, I guess we'll wait and see what happens with Trump, whether or not this actually does have a significant impact, or this is just another blip in the marketplace right now. But in the meantime, we'll see how this affects your mortgage decision. Now, I want to know from you, if you're listening to this episode and you're on the podcast, drop me a comment or hit me up on Instagram at themortgagepug or at Flow Mortgage Co. and let me know what you're considering. Are you on that fixed rate side? And if so, are you going short-term, mid-term, long-term, variable rates? Are you still floating the marketplace right now? And drop a comment below and let me know. Now, if you want to find out more about working with myself and my team, you can send us a DM at the same place, Flow Mortgage Co., where we help our clients pick options clearly. Catch you on the next one.